Good morning, good afternoon, good evening to everybody in our online audience. Good afternoon to everybody who's here with us at AGSI offices in Washington, D.C. I'm Doug Silliman, the president of the Arab Gulf States Institute, and I want to welcome all of you to today's program to try to figure out the economic outlook for the Gulf amid all of the economic uncertainty around the globe, and frankly, a little bit of political uncertainty as well. We're not going to cover this today, but the background for what we're going to talk about economically is a really difficult region. Everybody knows the very bad situation in Gaza. In Yemen, the Houthis have, in the past couple of weeks, sunk a couple of more ships in the Red Sea. There is a little bit of optimism on Lebanon and in Syria, but in the past 2 months, Israel and the United States have attacked Iran. And that leaves the Gulf partners, the countries of the GCC, with a lot of uncertainty about what's going to happen physically on the ground in the region. If you add to that economic issues, things become really complicated. All of the countries of the GCC have extensive vision programs that they are implementing to try to modernize and transform not only their economies, but in many cases, their societies. But oil prices have stubbornly stuck between $65 and $70 a barrel, which has made getting the money to finance these programs a lot more difficult. And on top of that, when President Trump visited Saudi Arabia, Qatar, and the UAE in May, he got pledges of nearly $4 trillion of investment and purchases over the course of more or less the next decade, which makes it much more difficult for the countries to figure out how to allocate the fiscal resources that they need for their own programs and to meet all of these pledges. Luckily, we've got an exceptional team, exceptional group assembled today to help you understand the economic uncertainty and what the Gulf can do with that, particularly through fiscal policy. We have people from the World Bank, from the IFC, and from Bloomberg Economics. But in order to do that well, I'd like to turn the conversation over to Safaa Tayeb El-Kogali, who is the division director for the GCC at the World Bank, and has come all the way from Riyadh for this program. So Safaa, let me give you the stage.
Thank you very much, Ambassador Silliman. It's a great pleasure to partner with the Arab Gulf States Institute here today in Washington, especially to present the findings of this report. And so, ladies and gentlemen, distinguished colleagues, thank you so much for joining us, both in person and online. I hear there's a wide array of people joining us online, so it's really a great pleasure to be here. The Gulf Economic Update is a biannual report that we produce on the Gulf, looking at economic developments and also focusing on a specific area that's relevant. And this edition is on fiscal policy, and especially in terms of how it relates to macroeconomic stabilization and equitable growth. Now, it couldn't be more timely, and Ambassador mentioned what is going on in the world, but really what's going on in this region. They have very ambitious development plans that they've been implementing in an impressive manner, both economic and social transformative agendas. And despite what we're seeing globally, they're sticking the course. However, we wanted to see, in terms of the fiscal policies that they have undertaken, where they are and how that impacted their economic growth trajectory, and my colleagues will go into details of that. But I think what's really important is how the report underscores the importance of fiscal policy for macroeconomic stabilization and for long-term development goals, and I really underscore the long-term aspect of it. The message is clear that smart, sustainable fiscal policy is not just about managing today's challenges, but it's really about enabling tomorrow's opportunities. And we, in this report, we actually shed light on Oman's story, which is a success story of how they've managed to use all the tools that they have in terms of fiscal expenditure restraints and spending smartly, but also looking at diversifying their revenue base. And it's a story that many countries in the GCC and elsewhere can learn from. And really our goal as a World Bank in the GCC is to continue to be a trusted partner, offering evidence-based policy advice, but also research that can help them move forward with their development agendas. We say it as it is, where it works, we say it works, where it doesn't work, we say it doesn't work, which makes us stand out a little bit from the consulting firms in the GCC. But it's a pleasure. I urge you all to read the report. I look forward to an engaging discussion. My colleagues will present the findings and then there'll be a discussion around that. So thank you all so much for joining us today. Thank you, Ambassador.
Good. Yeah, go ahead.
Thank you, Safaa, and thank you, Doug, for the introduction. Let me just add my welcome to everybody in the room and joining us online. For me, it's exciting to have the World Bank here. It's the first time we've jointly co-hosted an event with the World Bank here. So thank you to everybody from the bank, and particularly I think Ashraf Al-Said, and on our side, Bushra Lawrence and Raymond Karam, who brought all this together. We have a great panel to discuss the outlook in the GCC and some particular policy issues with us. In the room, we have Hoda Chattha, who is a senior economist at the World Bank and was lead author of the Gulf Economic Update report. We have Garbis Iradian from the Institute of International Finance, where he's the chief MENA economist. Then on screen, we welcome Hoda Youssef, who's the lead economist for the GCC at the World Bank, and Ziad Daoud, who's the chief emerging markets economist at Bloomberg Economics. How we're going to run this is Khudadad and Hoda are going to do some brief presentations on the main findings of the report, and then we'll turn to Ziad and Garbis to get their views both on the the content of the report, but also more broadly about the current economic situation in the Gulf. The idea is we'll leave plenty of time for questions, which of course we'll take both in the room and online. I just particularly ask online to submit the question in the Q&A function and get them in as early as possible. The earlier they're in, the more likely it is we'll get time to go to that. So I'm looking forward to a very good presentation. I'm going to hand the floor over to Khudadad for the first presentation, and let me pull up for him the Khudadad, all yours.
Perfect. Thank you very much for the kind introduction, Tim, and a huge thank you to all of you for joining this event. Now, over the course of the next 25 minutes, the objective is we have prepared 2 presentations for all of you. I mean, you can't see the presentation at the back, but you can see it there, so you might have to turn around a little bit. So the idea is to sort of give you a broad overview of some of the key findings of the last edition of the Gulf Economic Update. Think of this as a little bit of an appetizer so that we have a useful discussion later on. Now, let me start with the findings of the first chapter of the report, which is the recent developments chapter. Here, the broad objective is to sort of look at historical data for all GCC economies, which includes Bahrain, Kuwait, Oman, Saudi Arabia, Qatar, and the UAE, and to sort of give a sense check on the macroeconomic health of these countries. So the first thing that we cover in this report is look at economic growth. You can see the graph on the left, which basically simply plots economic growth for all GCC countries for the last few years. And you can see a lot of variability that has happened during this time. Aggregated growth figures don't tell you as much. So what we do is we sort of disaggregate between hydrocarbon sector growth as well as non-hydrocarbon sector growth. And here 2 very different stories emerge. On the one hand, if you look at hydrocarbon sector growth, which is the dark sort of green bars, you can see that there was an sort of hydrocarbon sector contraction in the year 2024 and 2023. However, if you look at non-hydrocarbon sector growth, that's been strong and resilient throughout the last few years and is a testament to the structural reform agenda and big ambitious visions that have been introduced throughout GCC economies. The one thing that I would say regarding hydrocarbon GDP growth for 2024 is, if you're following some of the news coming from OPEC Plus, there were a lot of these voluntary oil production cuts that were extended throughout the year 2024, which is why you saw this contraction. Now, moving on towards the monetary sector, we basically show headline inflation numbers. And here you can see that GCC inflation numbers for 23 and 24 are much lower than a lot of other parts of the world. And that's a huge success story for GCC economies. It's because of several factors, some fiscal subsidies to targeted sectors that have kept prices low, and the exchange rate pegs with the US dollar that have constrained monetary policy somewhat. We also go in the report in individual country sort of positions. For example, in Saudi Arabia and UAE, the bigger driver of price increases has been the housing and the real estate sector. If you've lived recently in Riyadh, Abu Dhabi, or Dubai, this is something that you will be able to resonate. Now, on the fiscal sector, each country has its own individual dynamic at play. So we think it's much more useful to go into a country-specific sort of a situation rather than having an aggregated GCC view. The graph on the left basically simply shows you how much the fiscal balance for these countries changed from 23 to 2024. Now, remember from the first slide, I was mentioning that there were these oil production cuts that were extended throughout 2024. As a result, what we naturally expect is that, commodity rents that the government has would be constrained. And so as a result, if you keep spending levels at the same level, fiscal deficits would naturally go up. And that's exactly what we've seen in several countries, but not all countries. Now, the second chapter of the report basically discusses the medium-term outlook, which Ambassador, you were also referring to. It's a 3-year projection of the World Bank. Before I go and share the results, I want to share one caveat, which is the cutoff date for this outlook is 1st of June. So any developments that have happened after, we have not been able to incorporate. This is our regular economic monitor. The next one is going to come out in November, December. So please keep an eye out. Any developments that happen over the next 6 months, we will incorporate. Again, here we basically discuss what might happen with economic growth in the medium term. Now, if you're following again some of the hydrocarbon sector, oil sector news coming from OPEC Plus, what we have seen is that the voluntary production cuts have already started to be phased out. Oil production has increased since April at an accelerated pace. So naturally, what we're anticipating in line with what OPEC Plus has been signaling is hydrocarbon sector growth picks up because oil production picks up in the medium term. So you can see that on the graph on the left with the dark green bars where hydrocarbon sector growth goes up in the medium term. But more importantly, you have non-hydrocarbon sector growth that is in line with recent trends, stable and resilient, and you might even get some of the fruits of the reforms that have been undertaken throughout the GCC. So you can see the light green bar is also stable in the medium term. Now, when it comes to government debt, the big picture message is that debt levels overall at an absolute level for most of GCC countries are at a low and sustainable level, except for Bahrain, where the debt to GDP ratio is above 120% of GDP. And that requires a solid fiscal consolidation effort to sort of bring down these debt levels in Bahrain. In other countries, you've had debt levels that are broadly well within a sustainable range. Regarding Oman, we have a separate presentation prepared for you, which Dr. Hoda is going to discuss after this. They did a successful fiscal consolidation effort over the past few years, used oil windfalls to be able to bring their debt levels down. So that's a good case study that we actually include in the economic update. Now, on the monetary and the external sector side, in line with recent trends of the past few years, we are sort of anticipating that inflation numbers stay low and stable throughout GCC. And that's because we don't anticipate a change in the policy mix. It's probably going to be a very similar policy mix with a currency exchange peg, with some fiscal subsidies to key sectors, keeping price levels low. On the external sector side, we're anticipating a slight improvement in the current account balance because oil production goes up. But this is highly conditional on what the oil prices would be. And that's a big question mark, which also has a lot of uncertainty on what the oil price might look like in 2 to 3 years' time. We also identify in the last part of this chapter, particular risks that the sort of GCC countries face. So the first two risks are trade and economic uncertainty, oil price and production fluctuations. These two risks are quite self-explanatory. Everyone has been speaking about economic uncertainty, trade uncertainty over the past few months, but we wanted to be a little bit more specific for the risk that is for GCC economies. Now, the biggest trading partner for GCC economies is China, which imports oil. Let's say if you have economic uncertainty happening throughout the world, and especially if China is affected by that economic uncertainty, you have lower sort of growth there, then all of a sudden you have lower sort of pressures, low downside pressures on the oil price. If oil prices go down, then all of a sudden that puts pressure on GCC economy. So that's a big risk that we identify. And the third risk is the risk of conflict spillovers, which again doesn't need further explanation. Even with our cutoff date of 1st of June, this is something that very much you can see throughout not just the GCC, but the whole region. Now, as Safaa was mentioning, this is our regular economic monitor. The first part of the report is what I just discussed, which is the core macro part. And then the second part of the report has a thematic focus. So we pick a particular topic of interest, we do a deep dive in that particular topic of interest. So last time around, we did it on the topic of water scarcity. We've done it on health, education, you name it. This time around, we've done it on the effectiveness of fiscal policy, a topic that I'm quite passionate about, and I hope that you also find the next few slides interesting. Now, before taking you through some of the findings, let me just sort of lay a little bit of groundwork. If you are sitting at a central bank in a particular sort of in a country X, let's say, for example, or at the Ministry of Finance, you're a macroeconomist. There are two main macro stabilization tools that you have available in your toolkit. One is monetary policy, which is your sort of central bank's interest rates, the balance sheet of the central bank, etc. And the second is fiscal policy, which is government spending, government revenues. Now, one thing to note regarding GCC economies is that most GCC economies have a currency exchange pegged with the US dollar. That has some benefits because it gives you exchange rate stability, but there's also a trade-off where monetary policy becomes less independent. So fiscal policy is the primary tool for macroeconomic stabilization in GCC economies, and it's important to sort of study this one. Fiscal policy might have many different objectives, but there are two objectives that we zero in on. The first is macroeconomic stabilization. What do I mean by that? Very simply speaking, if you're in country X, you want the country to grow, but you want the country to grow in a stable fashion, not in a zigzaggy way, right? In real life, however, what you see is what you see as on this slide, which is a simple stylized example of how GDP actually grows. Sometimes growth picks up a lot, sometimes you have like a little bit of a recession. And these ups and downs are what's called a business cycle. Now, one of the jobs of fiscal policy is to stabilize these economic cycles, and the way to effectively do that is something called counter-cyclical fiscal policy. What does that mean? Very simply speaking, if you're at a recessionary trough, the government should decide to spend more at that time. If you're at a business peak, you take a step back. So if the private sector seems to be slowing down, then the government steps in, does a fiscal expansion to sort of smoothen out the GDP growth path. The second objective is to improve the long-term growth prospects by doing sort of investment spending. These are the two objectives that we sort of narrow in on in our special focus chapter. Now, this, I'm not going to go into too much detail into these two graphs, but broadly speaking, from our last economic update and one working paper that's already been published by the World Bank, we've already shown that fiscal policy in GCC economies, broadly speaking, is countercyclical. That's very good news, of course. But then the next question is, let's say if you're the government or Ministry of Finance in country X, if you spend $1 in government consumption spending or $1 in government investment spending, how much does GDP increase by? Very simply speaking, in this graph, if you're at the recessionary trough, you decide to spend an extra $1 of consumption or investment spending, does that lead to increases in GDP? And if so, by how much? And that's an important question because that gives you a sense of like how effective your fiscal policy is to do macroeconomic stabilization. And this is precisely what we do. We use state-of-the-art econometric techniques. We use something called a local projection instrumental variable methodology to sort of estimate the fiscal multiplier. And this is what's called basically a fiscal multiplier, the effect of an additional dollar spent on GDP, of government spending on GDP. And we find that the fiscal multiplier for GCC economies is estimated within the range of 0.1 and 0.45. What does that mean? That simply means if a GCC government decides to spend an extra dollar in the form of a fiscal expansion, then non-hydrocarbon GDP increases by 0.1 and 0.45 dollars. Now, this is, of course, one part of it is good news that you have a statistically significant and positive effect. It's a little bit on the lower side, but there's a positive impact of government spending on increasing GDP, which is of course good news. The next thing that we do is we divide up the sample that we have into recessionary episodes where growth was low and expansionary episodes, and see whether the fiscal multiplier is higher during recessions. And here you can see on this graph that during recessionary episodes, the multiplier is much higher, which is what we would expect as well. So what does that mean in practice? If you're at a downturn and GCC governments decide to spend that additional dollar of money, that really seems to improve GDP and stabilize the economy. But during expansionary episodes, what we see is that the additional dollar of spending doesn't seem to lead to a lot of GDP increases. And finally, we look at government investment spending, which is whether government investment spending leads to increases in growth in the long term. And we find it does, but not by a huge margin. And that's exactly what we would expect. And I have a very simple example to explain this, which is that let's say if you're in a country, again, country X, forgive my lack of creativity on this one, and you have a private sector that seems to be struggling because it doesn't have access to credit, right? It's difficult for them to get loans. Mindlessly building infrastructure isn't going to solve the problem and lead to growth. It's going to be solving that binding constraint to growth that's going to lead to higher growth. So we should not expect investment spending to lead to high sort of increases in GDP to begin with. But from what we see, we do see increases in GDP as a result of government investment spending. So in short, the whole objective of this chapter was to give a comprehensive macroeconomic overview of fiscal policy. What we find is fiscal policy is counter-cyclical in GCC economies. It does lead to increases in non-hydrocarbon GDP, and it's been effective in stabilizing the economy during downturns. There could, of course, be further improvements in the efficient allocation of resources so that the multiplier number is higher than what we see in our estimates. And finally, government investment spending does lead to growth, but it's not a silver bullet, and that's exactly what we would expect. On the last slide, I've kept this QR code so that no one has an excuse not to download the report. But yeah, it's available online. And thank you so much for listening. And I really look forward to the discussion afterwards. Thank you. Back to you.
Thank you, Huda. So let's go straight to Hoda on the screen, who I think will share her presentation with us. Whenever you're ready, Hoda, the floor is yours.
Thank you, Tim, very much. Can you hear me well?
Yes.
Okay. So first of all, I would like to really thank the Arab Gulf State Institute for co-hosting this event. And it's really a pleasure to speak among such a distinguished panel. The report, as we have seen from Khudadad's presentation, is really an attempt to look at one of the key tools of macroeconomic policy, which is particularly relevant to the GCC countries, given their diversification plans, and to answer a key question related to the effectiveness of their fiscal policy. In the next 10 minutes or so, I will be presenting one of the success stories in the region, which is Oman's journey towards fiscal consolidation and its effort to redress its public finance and put it on a more sustainable path. So if you just give me a minute, I will share my screen. So let me maybe start by giving you an overview of my presentation today. Okay, so really what I would like to do today is take you over the vision in Oman, like a typical oil-rich country who was looking forward to reduce its reliance on oil revenue and to manage its public finance and make it less volatile and subject to global oil prices. I will be explaining briefly what are the economic shocks that the economy has been subjected to and the application of the reform plans. And then I'll delve a little bit more deeper into their medium-term fiscal plan that was adopted in 2020 and the commitments that they have took on board, and then how they managed to succeed in their fiscal turnaround, and a few points on the way forward. So basically, if you look at the economy, some 10 years ago or so, Oman was like any oil-rich country, its economy has been defined by oil and gas sectors as major sources of their economic activities. If you look at the hydrocarbon sector, crude petroleum had the lion's share of the activity at around 86%, while natural gas had the smaller part, although this part has grown over the years to reach 14%. That said, of course, real growth has been moving in tandem with the global oil prices, as we discussed, and you can see the high correlation between economic activity and oil prices in the graph in the bottom. So they have, some 10 years ago, started their diversification efforts, and these efforts have gradually paid off. You can see that, for example, in terms of the increase in some non-oil sector share in GDP, and that happened in tandem with the decline in the share of hydrocarbon GDP over the past 2 decades. So the graph on the left, you can see you have the light bar that reflects the last decade, and then the dark bar that reflects the decade before. And you can see clearly that the share of non-hydrocarbon has decreased, and services in particular have seen some kind of picking up. Among services, wholesale and retail trade sectors and public administration remain the largest, while some sectors that have been traditionally kind of branded as being the cornerstone of their diversification efforts, like tourism and ICT, they still remain small and have not really gained in importance. The manufacturing sector, on the other hand, has also gained in importance in the economy, but around 40% of it remains concentrated in the chemical sector and chemical products, which remains also very much correlated to oil activities. Now, in terms of the drivers of growth, you can see that non-oil growth has been reflecting the development in the oil sector as well. You can see a large correlation here. Although this has changed a little bit in the past 2 years or so. In 2023, for example, there was no growth at all in the oil sectors, while the non-oil growth has picked up and was showing positive growth. And the same happened in the following year, 2024. So we started to see this decoupling between oil activity and non-oil activity as well. On the external accounts front, typically as expected, the hydrocarbon sectors remain the cornerstone of Oman's exports, but this share has declined in the 2020s, starting that year. Typically, when oil prices go below around $70, Oman would suffer from current account deficit, and this is because, as we discussed, the share of crude oil remains very large, more than 60%. Although again, this share has declined in recent years. You can see, for example, the light bars here reflects the non-oil exports, which have substantially increased from around 12% in the past decade to more than a third now. So it's a positive development. Now, if we get a little bit more into the fiscal part of things, again, after the 2014 oil price shock, there was a depression in economic activity, and fiscal policy did not really adapt to those imbalances. So we could see that the decline in oil prices triggered a large decline in fiscal revenue. It fell from around 40% to 20% of GDP. And at the same time, public spending was not adjusted. It kept increasing. Of course, this was only possible because the gross financing needs were partially covered by their sovereign wealth funds, which is a good thing for counter-cyclical fiscal policy, as we discussed earlier. I think that the real cornerstone or the flagship kind of trigger for fiscal reform efforts was that the fact that the public debt increased a lot during that period. Before 2014, the public debt was almost non-existent, only at 5% of GDP. But then it had gradually increased and debt levels accelerated, peaking in 2020 to more than 65% of GDP. The bulk share of this was external debt, around 50% of GDP. And when COVID hit after that episode of increasing debt, of course, it has amplified the impact, and there was a series of credit rating downgrade to the Oman economy. Associated to that, of course, there was large liabilities in terms of debt servicing, which also kept increasing as a share of exports of goods and services. So all of this together motivated the government in Oman to adopt a medium-term fiscal plan. It had a 4-year period, and it's considered the really pivotal initiative aimed at restore the fiscal stability. And typically, it had plans for on the revenue side, on the expenditure side, and some targets for the fiscal balance. And it also had some reforms related to public financial management. So if I take you very quickly in terms of the main, the flagship kind of reforms that they have introduced, of course, they have introduced a value-added tax on goods and services with exemptions for essential goods. They had already adopted excise taxes on tobacco and harmful drinks since 2019, but they kept revising these. And also they had earlier adopted corporate income taxation with different rates for large companies and SMEs, and also for oil and gas companies. But again, they kept revising corporate income tax policies. In the graph, you can see that revenue from CIT was still limited, so that was also an incentive to consider further fiscal reform on the revenue side. On the spending side, there was earlier attempts to reform the subsidy system, to create a system where savings from these reforms would go to low-income groups. There was also serious attempts to contain public sector wage bill, which you can see that these have paid off. For example, the wage bill has decreased from around 12% to 8.6% in 3 years' time or so. There were also reforms on the tariffs of electricity and water sectors, although in 2022, there was kind of a reverse in policy when it comes to fuel subsidies that was associated to the global energy crisis, and they wanted to shield the population from the impact of those price shocks. In a nutshell, we can see clearly that the medium-term fiscal plan has delivered strong results. For example, on the left-hand side here, you can see the dotted are the targets, while the bars are the achievements. And you can see that they have clearly overachieved in terms of the fiscal surpluses since 2022. Public spending was also substantially contained, dropping substantially to 16% of GDP. Public debt also came down very rapidly. There was a fast reduction from 68% to 35% of GDP in 4 years' time, which is quite remarkable. And that was reflecting an accelerated debt repayment using oil windfalls. What's less successful, I have to say, is that the targets on the non-hydrocarbon revenue were not met. These revenue have grown only modestly over the medium-term fiscal plan timeframe, and it was only by 1.6% the increase, so quite modest in line of the reforms that they have undertaken. which means that when we talk about the way forward, of course, the economy continues to track movements in global oil prices, and this is increasingly a risk in a current environment of low prices. But we can see that there is a steady commitment to continue these efforts, and we, of course, commend these efforts. One of the major flagship reforms that they are currently about to introduce, they have already adopted the personal income tax, which is the first GCC country to introduce PIT. And it's also doing it in a gradual way. So it's only starting in January 2028. And for the time being, it's imposed only on high incomes. They have also joined the OECD framework on tax-based erosion and profit sharing. And they continue to focus on institutional capacity and improving governance in their tax system. So that's in a nutshell the Oman story. Let me just leave it here. Thank you very much. And I also look forward to the discussion.
Good. Thank you, Hoda. So maybe we'll turn first to Garbis in the room, and maybe Garbis, you could give us your views on the situation and outlook in the Gulf at the moment.
Yeah, thank you for the invitation. In general, I'm less pessimistic than what the World Bank speakers mentioned because about the risk of low oil prices. The way we see that oil prices most likely will stay between $60 and $70, even if it stayed for a sustained period of time. And the reason for that is the US oil production, the cost of US oil production is around 60 or so. And given the strong relationship that we have seen, which developed in the past few years between Saudi Arabia and other Gulf countries, the policy is to keep oil prices low so that gasoline prices in the United States will be low, but not very low to hurt the energy sector in the United States. So that's given. I'm working with that assumption, which means Saudi Arabia, UAE, and other Gulf countries will be able to adjust oil production, which we have seen it recently. Saudi Arabia increased oil production in June by 700,000 barrels. And this will be one of the drivers of growth. And also, it would compensate for the likely loss in oil revenue from lower oil prices by having more exports in volume terms, which means the fiscal break-even prices of oil for Saudi Arabia and even other countries, Qatar and UAE, will continue declining. Saudi Arabia fiscal break-even price last year was $95. Now our estimate, based on the oil production and the restrained spending, even with spending increase of 2 or 3%, it will be something around $85 per barrel. The kingdom could cope with such a situation of having a fiscal deficit in the range of 3 to 4%, given the low debt that you have. Now, so I'm not worried about oil prices staying between 60 and 70. The region will cope with such a situation, even with not much tightening in the fiscal policy, because part of the investment in the economy is coming from public entities, like the Public Investment Fund, Tim, you know that about, which is the Sovereign Wealth Fund. The major projects in Saudi Arabia are financed by the Public Investment Fund, which is not part of the central government budget, which means even the central government spending on investment drops, still it will be more offset by the spending of public entities like the sovereign wealth funds in the UAE, Saudi Arabia, etc. So that brings me to the issue of investment that you mentioned, that you're worried with the tight fiscal policy, investment could drop. I think no. It will be, if we look at the component of the investment, you have private investment by Saudi Arabia, you have foreign direct investment, you have central government investment, and you have investment by other public entities. So what's happening now, even if the central government investment declines, it would be partly offset by the public investment fund in Saudi Arabia, for example, and FDI. That brings me to the issue of what happened, the deal between the Trump administration and Qatar, UAE, and Saudi Arabia. There will be inward and outward investment. Even if we assume out of these 2 trillion deals, even 10 or 20% are implemented in the next 4 years, you will have a large increase in inward investment. Of course, outward investments from Saudi Arabia, UAE, and Qatar will flow to United States, but they will benefit from this transfer of technology to the region. So potential growth will improve. Plus, you will have investment to GDP ratio not declining. So that's why I see the growth outlook, the non-hydrocarbon growth could be at least 4% beyond this year. This year could be about 3.5 or so on average, but in the medium term will be at least 4%, even with lower oil prices. In the past, of course, there was a relationship between strong relationship, lower oil prices, fiscal tightening, slower economic growth. Now it's breaking down that. On the investment side, I'll give you an example. UAE, last year's UAE foreign direct investment was 44 billion, about 9% of the size of the economy, which is the highest among all emerging economies. I could see some potential also for Saudi Arabia, FDI increasing in the next years, mainly coming from United States. So that's the compensating factor. So that's on the overall picture. A fiscal deficit of 3 or 4% they can cope with. Saudi Arabia, for example, given the debt to GDP ratio is 34, 35%, they can still easily borrow from the international market at favorable terms because the rate of return on their sovereign wealth fund assets exceeds 7 or 8%. So it's better for them to borrow from the international market to finance the fiscal deficit. So I don't have any worry on the fiscal side, with the exception of Bahrain. Of course, Bahrain is a different situation, but it's a tiny economy in the region, which will be continued to bail out by the kingdom.
Good. Let me go to Ziad. You've written a lot, Ziad, on fiscal break-even oil prices and so on. So I'm sure you have views on all of this as well. So over to you, and I think you have a presentation to share on the screen, right?
I do, Tim. Thank you so much. Thank you for including me in this amazing sort of gathering. Thanks for the World Bank for the report. I do estimate break-evens quite often, but I'm not going to talk about them in this presentation, but happy to talk about them in the discussion. What I want to talk about is I want to make 4 remarks on GCC fiscal policy. And these 4 remarks will hopefully cover all 6 countries in the GCC. And I'll do that very briefly in 6 minutes. The first remark is, if we want to talk about public fiscal policy in the GCC and we want to talk about urgent places, we should focus on Bahrain, we should focus on Oman, and we should focus on Saudi Arabia. And the reason is the other 3 countries, Kuwait, the UAE, and Qatar, basically have so much hydrocarbon wealth, have so small relative population, that fiscal policy is not an urgent problem. Yes, it's nice to diversify the economy. Yes, it's nice to have other sources of revenue, but it's not a must and it's not an urgent. Where there's more urgency is in the other 3 countries, Bahrain, Oman, and Saudi Arabia. So let me start with Bahrain. That's my second remark. Bahrain's debt undoubtedly is unsustainable. How do we define unsustainability? We define unsustainability if the debt to GDP ratio continues to rise non-stop. If I look at the report from the World Bank that we're discussing today, the 3-year out debt to GDP ratio in Bahrain forecast is they, Khudadad presented he had the chart, but he showed Bahrain's debt to GDP ratio rising all the way out to 2027. If I look at what our friends at the IMF are predicting, they're predicting rising debt to GDP ratio in Bahrain all the way out to 2030. And it's not rising from a low level. It's rising, if we believe the forecast, for example, Bahrain is set to become the 3rd most indebted government in the world by 2030. The first one is Japan, but Japan is a major economy. It's a safe haven. It issues debt in local currency, and a central bank owns most of the government's debt. These rules don't apply to Bahrain. The 2nd most indebted country in the world by 2030 is going to be Singapore, but Singapore's public debt is a mirage. The government issues debt not to fund budget deficits, but it issues debt to make sure there's a debt market and has a humongous amount of assets. So yes, Bahrain is going to be probably the 3rd most indebted government in the world by 2030, but in effect, it's probably going to be the most indebted government in the world by 2030. And if something is unsustainable, it means it can't go on forever. Something needs to happen in Bahrain. It's not a question of if, it's a question of when, and it's a question of what will happen. And the menu of what could happen if a GCC country runs into a debt issue is a menu that consists of 8 items. So Bahrain will pick some of the stuff from the 8 items. What are these 8 items and what is Bahrain likely to do? Let me move on to my 3rd remark, which is related to Hoda's presentation of what happened in Oman. Because Oman is sort of case study, is an interesting case study, and it's an interesting sort of success story. Oman has managed to halve its debt to GDP ratio this decade in about 5 years. That's some feat, that's some achievement. How did it do this? What kind of items from this menu of 8 did it choose? Well, let me just talk first about the stuff it didn't do. Bahrain didn't inflate away its debt. The inflation was not higher in this decade versus the previous decade, not significantly. It didn't get a bailout from its neighbors. It didn't devalue its currency, and it didn't default on its debt. So these tools it didn't use. What did it do? Well, it got lucky with higher oil prices. It did increase non-oil revenue. Hoda mentioned the VAT that was implemented in 2021. It did cut expenditure, and it did increase non-oil growth, which lowered the debt to GDP ratio. Now I have 3 small questions, sub-questions on this, both to the other speakers, but also to the audience. My first question is, given what Oman did, how much of that do we think? So we know it did 4 things. How much of that was due to good policy? How much of that is due to good luck? Good policy is increasing non-oil revenue, is lowering expenditure, and it's increasing non-oil growth. Luck is obviously higher oil prices. I have my guess, but I invite the audience and other speakers to give me numerics about how much they attribute to policy and how much they attribute to luck. The second question, and it's probably our friends at the World Bank might be able, especially Khudadad, given his work on the fiscal multiplier, there's something that doesn't quite add up here for me. In the sense that if you tell me that a country is cutting expenditure, if you tell me that country is increasing non-oil revenue through higher taxes, I would guess that growth would slow down, not increase, especially non-oil growth. But Oman managed to increase non-oil growth at the same time as cutting expenditure and increasing non-oil revenue. And this for me is a sort of a puzzle. I know this has happened. How and why did this happen is something I'd love to hear the answer for. And the third sub-question that's related to this, we talked about Bahrain being unsustainable. We talked about choosing among this menu of options, menu of 8, what will Bahrain do? So we know what Oman did. What will Bahrain do eventually when it decides that is too unsustainable and it needs to do something? Well, what is clear is that markets, as Garbis has mentioned, are betting that Bahrain is going to do something that Oman didn't get, which is it's going to get a bailout from its neighbors. Will these bailouts be enough to sustain the Bahraini debt, or will it just mean that it will have to choose one of the other 7 items in the menu further down the road? That's a question that is worth asking and maybe pondering. The last remark I want to make is this. The fiscal policy in the region is not just a domestic issue. It's not just an issue that's related to increasing taxes and what's going to happen to growth and what's going to happen to expenditure and employment. It actually shapes the region's relationship with the world. If you think about the region's role, the GCC's role in the global economy, in a reductive way, it provides two things. It provides energy and it provides capital. And if you think about, the event is held in Washington, D.C. President Trump came to the region in May. He came to the GCC seeking two things. He was seeking lower oil prices and he was seeking trillions of dollars of investments. But fiscal policy is changing that. Because yes, Kuwait is still an exporter of capital to the world. The UAE is still an exporter of capital to the world. Qatar is still an exporter of capital to the world, but not Saudi Arabia. That changed last year. Tim has written about it. I have written about it. Saudi turned from a net lender to the world to a net borrower from the world last year. That change is set to continue because it happened when oil prices were $80 per barrel last year. When oil is now lower, below 70, that is expected to continue. And the reason why this happened, the reason why Saudi Arabia has turned from a net lender to the world to a net borrower to the world is because of fiscal policy. Saudi Arabia is spending a lot, and that is making it increases basically the needs for imports, and imports require funding, which shifted its role from a lender to a borrower from the world. Let me conclude by summarizing just what I said. The four things I want to say is we shouldn't worry so much about fiscal policy in the UAE, Kuwait, and Qatar. 2, Bahrain's debt is unsustainable. It's worth thinking about how this will end. 3, Oman has made significant improvement in terms of halving its debt to GDP ratio. There are still some questions I'd love the answer for, but the progress is undeniable. And 4th, fiscal policy is important. It doesn't shape just domestic economies, but it shapes also the region's relationship with the world. Look at Saudi Arabia. And I'll stop here.
Very good. Thank you, Ziad, and thank you to all the panelists for really interesting comments. I want to give Khudadad and maybe Huda a chance just to quickly respond to Garbis and Ziad's points. But I also want to throw in myself a question, and I guess I probably sit somewhere between Garbis and Ziad in terms of where I would worry about fiscal. I think at the end of the day, I'd worry less about Saudi in the sense that debt is low, but where I do worry about Saudi is the efficiency of some of the spending, and particularly from the Public Investment Fund. And I'm just wondering whether there is anything we can say from the World Bank report about, I suspect you've done it on government, not on sovereign wealth funds, but I think taken at face value, the multipliers on investment in the region are not encouraging that the sort of money is necessarily going to result in strong, medium-term growth based on the history. So I wonder if you could also maybe just, sort of at least broadly discuss, how you marry something with the low multiplier against what may be adding to the public sector debt more generally defined here. And then after that, we'll go, if anybody has questions in the audience here, please just raise your hand. We have a few questions online as well, which I will get to. And if others have questions online, please submit them as soon as possible. So maybe Huda, go to you first and then to Huda.
Of course, thank you very much. Really interesting remarks. Thank you, Ziad, as well, for sharing those remarks. So on the work on the fiscal multipliers, one thing that I want to clarify is we're estimating these multipliers based on budgetary spending. What we're excluding out is sort of a huge sovereign wealth spending, which is from the Public Investment Fund or any other sort of sovereign wealth fund in the region. Now, of course, theoretically, what you might expect is because sovereign wealth funding is allocating those resources into sort of private companies, etc., that's doing all of the sort of private sector activity, the multipliers might be higher. But I'd love to do this work, but we just don't have the data to be able to do so. That's one factor. At a macroeconomic level, there are several other factors that could describe why some of these multipliers are lower. One is like, let's say if you have a closed economy versus an open economy, if you have an open economy, then some of the fiscal stimulus can sort of leave the country, right? That can lead to sort of lower increases in GDP. And I think where I think we need more research at a microeconomic level is to understand exactly what budgetary spending, where that money is being allocated. And the broad policy message is to allocate it in sectors where you get the highest sort of return, right? But we need further research at a microeconomic level to be able to identify where some of those gaps are. Now, Ziad, you had a very interesting question on the introduction of taxes. One thing that I didn't include in the presentation was, which will be coming out in the working paper over the summer, over the next couple of months, is we also estimate the revenue, the multipliers that we're showing was for government consumption and investment spending. We also do it for sort of revenue instruments, right? Tax multipliers, and tax revenues are generally sort of scarce in the GCC to begin with. So what we find is that these multipliers are indistinguishable from zero for tax multipliers. And typically, you expect that multiplier would be negative, right? When you introduce a tax, that leads to a reduction in GDP. That's exactly what you're referring to, Ziad. But what we find in the data is that we see zero multipliers for even the tax instruments. And the potentially some of the reasons could be that you're starting from such a low base of taxation that introducing it at a marginal level doesn't seem to sort of influence GDP as much. But I'd love to hear what some of the other mechanisms at play could be. So hopefully that answers the question.
Yeah. Can I add something on the?
Yeah, go ahead.
On the fiscal multipliers, I think it all depends on the period that you're taking in your econometric estimates. My view is that the efficiency of government spending has improved over the past 10 years or so as compared to the 1990s and 2000s. So the quality of investment has improved a little bit. So if you take a sample panel regression, for example, you take it for the past 10 years for 6 countries, you will get a different fiscal multiplier than the previous period. Another issue on the Oman, Ziad, you raised interesting issue whether it's policy or not. I would say it's mostly policy. First, they restrained spending. Second, they introduced tax reforms. And the luck, a little bit, I would attribute it to the increase in refined products, petroleum refined products, which is not under the production quota for OPEC plus. So you would see that the hydrocarbon production in Oman, which includes crude oil, condensates, and natural gas, did not drop as in Saudi Arabia and other GCC countries for the reason that refined products production has increased, natural gas production has increased. So that helped them on the hydrocarbon production side.
Who did you want to make any comments in response on Oman? And maybe let me just take the opportunity to throw an online question in as well on Oman. And it's like, now that the personal income tax has been passed, what should be the next priorities for fiscal reform in Oman?
Yeah, sure. No, thanks very much for the discussion, for comments from both Garbis and Ziad. Maybe let me start with Ziad, very provocative, I would say, question, but interesting one about policy versus luck. I would say, how can I frame it? It's policy in using luck, if I may put it this way. So, of course, the main element that helped them kind of introduce that was when in 2018 when oil prices started recovering. But what typically resource-rich countries do when they finally get some recovery in oil prices is they start spending more, right? So they could have used these windfalls from higher oil prices to expand their subsidies system or just do more spending, even capital spending. What they did is that they actually were aware of the same element that you were describing at the beginning of your talk about Bahrain, that debt was increasing, and it was increasingly doing so at very fast rates. So they very quickly and rapidly realized that this is going to unsustainable levels. As I explained, they went into a series of downgrading for their credit rating. So it was really kind of a snowball effect that pushed them to introduce the reforms. So it's a bit of luck, but that happened. Oil prices happened for all other GCC countries. Some of them were not as reactive and as pushy in fiscal consolidation as Oman. So I think it's very commendable from their side. On taxation and specifically on personal income taxation, as mentioned as well. So this is the first country in the GCC to consider income taxation for individuals. And it's still very early on. Actually, they will start introducing it in 2028. And they're taking it very gradually. So I wouldn't already think about the next step because it's already a very big step. And as we know in the region, taxation is very, it's not just the fiscal aspect, it's a lot more. It's also would have implication on the labor markets because of the large population of expatriates it attracts. It's a social contract as well. So I wouldn't already start thinking about the next step, but rather more about how to safely apply and the personal income tax. It also comes with a lot of administrative burden, so they need to get their books and their systems adapting to this new taxation. Thank you. I'll stop here.
Do we have any questions in the room or comments in the room? Yeah, please. And if you could maybe identify yourself.
The World Bank, what the executive director would advise for the executive director of the World Bank. So questions on the non-oil GDP that was in the study that was conducted on the definition of non-oil GDP of non-hydrocarbon is actually different than Kuwait, different than Saudi Arabia. So the definition is not the same for non-hydrocarbon. So I see here in the study, you combine them as non-hydrocarbon. That's basically, we could revisit this and maybe you have a unified definition of non-oil GDP for all because there's no official definition of non-oil GDP. That's maybe one point. Second point on Bahrain, debt to GDP, that we see the high increase of percentage as percent of GDP. Is that because the absolute debt is increasing or GDP is declining? That's a question. And also saw the imports for GCC is declining on the next 3-4 years. What are the drivers of the imports that are actually declining? Imports for GCC on the slides we see is declining for the next 3 years. On the fiscal multiplier that you said is very low.
Maybe this is the last question, right? Because you had 3 so far, so we'll give you this one.
Okay, this is a question on fiscal multiplier. Like you said, it's actually low. But I see this is normal. But which one? We need to balance between development, spending, and growth. So that we see if we shift spending on education and health and manufacturing, that of course we will have a higher spending on the front. And that's it. And maybe focus on oil revenue, not oil prices, as this has been basically Saudi Arabia and others been cutting productions to stabilize oil prices. Focus on oil revenue rather than oil prices.
Nice. I think those are for you.
Okay. Yes, thank you. I have 4 questions. I'm the lucky guy to be. So thank you for those questions. On the last question, I mean, it's a function of production, but as well as prices. No, when we look at oil revenues that a government has, it's both. So oil production, let's take the example of Saudi Arabia. Oil production levels that they decide is also a super important factor, but so is the price, which is why everyone keeps a close eye on what the prices would be, because for each sort of barrel of oil export that you make, you get more or less depending on what the price is, which is why we look at the price, but it's not the only factor. We look at both the production numbers. So like in my presentation, I was going through why one of the drivers of increase in hydrocarbon GDP or oil sector GDP growth was precisely because the production number was going up. That's the big driver. But the reason why in this room everyone is concerned about the price side is because that's the other half of the equation and would determine what amount of fiscal revenues that you get on the external sector side as well, like what the value of in nominal terms, the value of the exports. On your question on the multiplier, absolutely, there would be strategic priorities for the government. So of course they would need to sort of deliver. I mean, like I said, fiscal policy as role of the government is beyond what fiscal policy. It needs to provide all of these services. What we are providing is an aggregated view of what for each dollar of government consumption spending that you get an increase in GDP, right? This is not to say that government shouldn't provide the basic services in X sector or Y sector. It's just saying, okay, what are ways in which we can further improve the efficiency of government spending so that you get a higher multiplier, let's say, when we compare it to other countries. But I'd love to hear other views as well in the room. And point taken on the non-oil, non-hydrocarbon definition. I look at the definition in more detail and then perhaps get back to you. There was a question on Bahrain, right? On whether that increase is because of a decline in GDP or because of. So the increase is because with the thing that happens with debt is when debt levels become too elevated, it goes on an unsustainable path where it just keeps on going up. Right? Like think of it this way, like let's say if I'm someone who takes a loan from, let's say, Ashraf, and I take too many loans, then my interest payments become larger and larger and larger. So it's not even a function of like what your GDP is at that point. It's just going to become unsustainable beyond a certain point to begin with. So that's what we are highlighting. And then of course you can do a more detailed assessment of that sustainability analysis, but for Bahrain to have that level of debt above 100% of GDP means that it's broadly very high and requires a consolidation effort to bring it down. Hopefully I've answered some of your.
If I may add on.
Can I just add
Sure.
Actually the question was to you and Ziad on Bahrain. So how is Bahrain able to finance roll over, maintain the debt level, finance fiscal deficits and so on at the moment? Where is it able to borrow from? And then secondly, is there a view in the market of, what extent is there a moral hazard here, basically with, investors expecting Saudi Arabia or other GCC countries to come in and basically, in Ziad's slide, bail out Bahrain again. So you're both very close to the market, so if you could comment, maybe both of you on that.
Yeah, on Bahrain, yes, okay. The fiscal deficit is large, and the question is how it is financed. I think more than 50 or 60% of the financing of the deficit is from the international debt market. Although they are at high risk, they still have access to the financial market. They are borrowing, and partly also they are borrowing from other GCC countries, and the rest is domestic financing. But this cannot continue indefinitely. If you have a situation where oil prices stay about $60 and the fiscal deficit is 7-8% of GDP, at some point they have to adjust. I think they will be forced to adjust on the spend there. But they take into consideration this political environment or the structure of the population, where you have more than 60% of the population Shia. So you cannot push it too much on the population with the fiscal adjustment. On the hydrocarbon, non-hydrocarbon issue, how you define it. Hydrocarbon is mainly crude oil production, natural gas production. But anything, if you have oil production and you refine it, it goes to manufacturing. So there, the definition. And we look more at non-hydrocarbon real GDP growth because that's a better indicator of economic activity in the country. More than 95% of the population or labor force work in the non-oil sector. So this is what we look at. So it's basically a counting issue. If you look overall production, real GDP, you say, oh my God, it was negative. It could be negative, crude oil production dropping by 10%, but non-oil real GDP growing by 5 or 6%. So you have to look more at the non-hydrocarbon real GDP growth.
Yeah, just to add to what Garbis said, in terms of Bahrain, yes, I think international markets still into Bahrain and still assumes that Bahrain will get a bailout to some. I think that's the running assumption. If you look at the yields that Bahrain is paying, if you look at the credit default swap prices, they're all very tight. So they're not showing that a country is on the verge of fiscal crisis. And I think the underlying assumption there is that we'll get a bailout in the 2020s, the same way it got a bailout in the 2010s. On oil and non-oil GDP, I think everyone in the all the speakers have covered a lot of ground. I'll just say one thing, and Tim, you and I have discussed this quite often. It is called non-oil GDP or non-hydrocarbon GDP, but it is heavily dependent on oil prices. If the government sells oil and spends it on construction, large construction projects in the country, construction growth goes up. That counts as non-oil growth, but it's funded by oil money. If the government gets a lot of revenue from oil and then spends it on a mass public sector hiring, public government services will increase and they count as non-oil activity. So non-oil activity, I agree with Garbis, and everyone I think agrees, is the real indicator of the health of the economy, far more than the oil headline GDP, but it's not independent of oil prices. If anything, it's even more correlated with oil prices than the headline GDP number. So it's not an indication of any source of diversification whatsoever.
But this dependency has been reduced in the past 10 years because there are other forces, whether it's FDI or other investment also. In the past, I would agree with you that lower oil prices, tight fiscal policy, less spending, feeding to the non-hydrocarbon sector. But to some extent now, this is gradually, the correlation is weaker than this. But again, oil prices plays an important role.
I suppose we'll find out when oil prices decline and see what happens to non-oil growth.
I think it might well have declined in the last decade, but it's still the dominant force.
Still significant, yes.
Do we have other questions in the room?
Can I just bring it up?
Yeah.
So yeah, that's a very good point, and I think that's an empirical question, which I saw some of your posts on online as well. It's a research question that someone needs to really look at what the linkage between the oil prices and the oil sector and the non-oil sector is. Currently, we're speaking correlations, but we, I think it would be good to have some causal evidence to show what the extent of the linkage is, and what the extent of, let's say, if you do see non-hydrocarbon sector growth, what part of that is like diversification versus not. And then there's also the PIF in the picture, right, where the financing is coming from. So it's a good point.
Yeah, question over here.
Yes, hi, Shahid. I'm doing my PhD at SAIS, focusing on energy security and the interrelation and interdependence between East Asia and the Gulf in terms of energy. So I think another dimension here we need to introduce is geopolitics and how it's actually shaping the energy market. We've seen in the last few years since the Ukraine war how it actually shaped, redefined, the energy map between East Asia and the Gulf, and also the Red Sea disruptions that was mentioned earlier, and how it kind of rerouted things there. And that's why I think countries like, the GCC are important to 3 or 4 main countries: Japan, China, India, and maybe South Korea. So I think whatever happens in those countries in terms of changing energy policy is also going to affect how Gulf countries are also shaping their own policies. So geopolitics, I think, is a very component here that could actually shift things and make countries or the GCC countries reactive towards certain changes that are happening. And another point is, I think, is maybe in the Oman case, and also maybe the general GCC countries, is hydrogen and the investment in hydrogen, and how is that actually moving forward more in the emerging countries than in developed countries. How there's a lot of trust in it in terms of technology development. But again, maybe going back to Ziad's points, it's also coming from hydrocarbon sources. Like, it's mainly blue ammonia, which is of course extracted from LNG. So I think Gulf countries can lead both in the hydrocarbon sector, but it seems that they're also doing great in terms of the non-oil or let's say non-hydrocarbon sector. So I'd love to hear more about that, like East Asia, GCC relations.
Yeah, on the first one, if I understand you, so what happens if the Chinese economy weakens or other emerging economy weaken? The main channel is on oil prices because global demand for oil will decelerate, the growth in demand. But I would focus more on the supply side because you have a situation of global demand for oil. It could vary, the growth in global demand for oil, whether it's 1 million barrels a day or 2 million, they increase. A weakening of the Chinese growth, let's say from 5% to 4%, how much difference it will make? Because the incremental demand for oil is mainly coming from Southeast Asian countries, China, India, and others. So of course, weakening there will affect oil prices. So the channel is to oil prices. But then at the same time, you look at the supply side. So you could have a situation that global demand for oil weakens, but if supply is tight, it drops. Let's say United States supply production now is flattening. It's not increasing as before. So then oil prices will stay relatively at certain levels, 65 or 70. And this is the situation where we're seeing now non-OPEC plus production is flattening, particularly in United States. So there is an excess supply of oil. And this is one of the motives why Saudi Arabia increased its production in June. So I wouldn't worry of weakening in global demand for oil from Southeast Asia as long as the supply around the world is tight, which means that oil prices could stay above $60 per barrel. I don't see a situation over the next 2 years that oil prices will drop below 60 and stay below that level for a sustained period of time, which will hurt the GCC economies. When you have oil prices below 60, other marginal producers in the United States and others, they will not be profitable to increase production. Even production will drop. So the market will balance.
I think the only couple of things that I'll add is, of course, absolutely geopolitics is important, right? But again, that's something that's not an area of expertise for me. The only thing that I will say is that generally speaking, let's say if you're any country, it's good to have a diversified set of trading partners, right? So let's say if there are supply disruptions on a particular route, then you have a more sort of a diversified portfolio of trade partners. That's generally sort of the advice that we also give. But that's also a function of where the demand, let's say, if most of the demand for oil or energy is coming from like a particular trading partner, you have less control over it. And your second point on, energy diversification and hydrogen, that's been a big part of the discussion as well by our energy team. So perhaps that gives us ideas on the next special focus. We could think about something on energy. I see Hoda wants to comment. Yeah.
Yes, thank you very much. Very tempted by the discussion. So I want to react to a few things related to the oil price versus production. So I think it's Khudadad who pointed that at the end of the day, what's really important for the GCC countries, it's the oil revenue, right? Part of it is dictated by the oil prices, the global one, and then the other part is also oil production. And we've seen that in the past couple of years, because of the OPEC Plus initiative to reduce oil production, and then some countries like Saudi Arabia have taken even additional steps to voluntarily even cut more their production. That's when you started seeing, by the way, Ziad, the current account dynamics reversing and Saudi Arabia becoming a net borrower from the rest of the world. So it was kind of, we all know this is kind of a strategic kind of decision to restore some balance to oil prices, because at the end, it's a mix of two, and I would say it's a fine line. But I also want to react to the fact that your question about how much of the non-oil growth is actually driven by oil sector dynamics. I couldn't agree more to that comment. But I see that the countries who are actually using the windfalls of oil to finance their diversification efforts are taking serious steps to make that not a destiny. So even in the current time, if a lot of this is financed by oil revenue, including through PIF, by the way, because at the end of the day, if you think about what are the sources of financing for the PIF projects, part of it is the returns on assets, and part of it remains from oil revenue. So it still plays a very big role in the economy. But I think what the country is betting on is that gradually and in the maybe longer term, and there is an indicator to measure that, by the way, it's like private sector non-oil growth, right? Because that wouldn't be financed by oil, at least if you take out the private projects that are financed by the PIF. So that we can measure that and we can monitor how things are going. And Garbis also mentioned FDI as one important element and factor in how these economies, and we've seen that not all GCC countries are equal in terms of their attraction to FDI. For example, the UAE is doing very well, while Saudi Arabia is kind of volatile depending on one-off sources of FDI depending on the year and sell-off in Aramco and other elements. So yeah, thank you.
I have a question online I wanted to get to before we close out, and it's how will the tariffs that are being imposed in the US and the uncertainty that's creating potential retaliation affect the GCC region in terms of their fiscal positions and in terms of the growth outlook?
Perfect. I think I can take this one. So we discussed this in the report as well, where like the introduction of these tariffs or changes, etc., how could they impact the GCC economies, right? There are two types of implications. One is the direct impact of the introduction of tariffs, because it's basically like a tax. And the second is indirect implication, right? When it comes to direct impacts, the impacts we think would be quite limited because the initial tariff rate for GCC economies is quite low. Oil is an exception. So direct implications we see very limited. More of where the risk comes from, which I also discussed partly in my presentation, is the indirect effect. So let's say globally, if you have an economic slowdown in most of the world, then no country is immune. And you have different regions in the world, different parts of the world that have different levels of exposure to a global slowdown. And specifically for GCC economies, the exposure comes more on the commodity export side and more on, okay, if you have like broad economic uncertainty happening globally, then all of a sudden, you have downward pressure on your oil prices because there's a slowdown generally. And also, all of these countries want more FDI flows to come in. If investors are spooked, they cannot predict what the policy mix is going to be in the medium term, then they're not going to put their money in an investment project for like 5, 6 years, 10 years, which is the big risk when it comes to economic uncertainty in general. So in a nutshell, very limited direct implications, but indirect implications that could be relevant for not just the GCC, but for all countries in the world.
Oh, you want to add anything?
Yeah, I fully agree. Yes, other than the channel through lower oil prices, the indirect effect, you could have a situation, lower global growth affecting tourism, for example. For example, in the UAE, depends on UAE and Oman highly so, less tourism or so. But there are other products other than the oil, like aluminium and copper. Aluminium, for example, is one of the major exports of UAE and to some extent Oman to United States. So now with the high tariffs on aluminium, that could impact it a little bit. But again, the other direct effects are small because oil and natural gas are exempted from the tariffs.
Okay, we'll take one last question and then we'll close up, please.
Yeah, I'll be very brief. My name is Silliman from World Bank. It's my question about corporate taxes. In the report, I think it mentions that domestic revenue mobilized mobilization from corporate taxes remains weak at like between 3 to 5% of total tax revenue. And then Hoda mentioned in the case in Oman's fiscal reforms that there was a 15% corporate tax that was implemented. But Hoda, I think you mentioned that there were some fluctuations or some challenges. Were those challenges, were there negative impacts on competitiveness or investment? Can you elaborate a little bit more on the fluctuations that was?
Go ahead, Hoda, if you want to.
Yeah, sure. No, on corporate income taxation, the point is, again, Oman, if your question is about Oman, had introduced corporate income taxation many years ago. And in the context of their medium term fiscal plan, they had revised and introduced some of the changes. There are two main kind of features of corporate income taxation in Oman. The first one is that they have differentiated rates for enterprises depending on their size. So for smaller companies, they have only a 3% taxation, which is good to increase the tax base. Or why they're heavily taxing oil and gas companies, I think it's around 55%. So they're doing this differentiation. The reason why it's not yielding the results or the income that it should is that also in the same taxation legislation, there is a lot of exemptions and tax exemptions, of course, and especially when it comes to certain economic zones where there are also kind of tax exemptions, and it's also capped at 15%. Now, what will happen with the introduction of the global minimum tax around the world is that you will see those tax exemptions having to go away, and that's also one of the reasons to expect that CIT can raise more revenue in the future.
Ziad, I'm conscious that we haven't come to you in this last round, so I'm just going to see whether you have anything you want to add on any of these last round of questions before I wrap up.
Okay, nothing useful to add, Tim.
Okay, very good. So I'm going to bring this to an end. Before we do, I want to again thank the World Bank for partnering with us for this event, and to thank Khudadad, Garbis, Ziad, and Hoda for their presentations and general contribution to the discussion. Thank you all for coming in person, and for those who joined us online as well. And I hope everybody found it a useful and productive conversation. So thank you very much.